All right, we're going to talk a lot more about the integrity of this data for CPI, or questions about it at least, coming up later in the show. But first, the number itself. What do you think this means for the market?
There's a couple of things that this data means for the market. The first is to acknowledge that 0.3% month-on-month inflation doesn't sound like a big difference from 0.2% month-on-month, but if we had that number through to the end of the year, core inflation would be at 3.5%. So we would really like to see those numbers lower over time. I think the second thing we need to look at very closely is the gap between goods prices, which, as you mentioned, we expect to reflect some tariff pressure, and service prices. Now, over the past several months, investors have benefited from the fact that even as goods prices have started moving higher, services prices have been disinflating. But in the PMI data, services prices paid have been moving up for the last 3 months consecutively. So I've been sleeping with one eye open on this data, let's say.
So I want to be clear at what you were saying earlier, because I want to make sure the audience catches it. Remember, it's an early show. You're saying if we saw the same increase month over month throughout the end of the year, we would end the year at 3.5%.
That's exactly right.
All right. I want to go back to another point that you made about this inflation print. You're saying it will be benign, quote unquote, in your mind, if it's just on goods. But services inflation is something that you're watching. Why are you so focused on the services inflation?
A lot of it has to do with the way the market has become more comfortable with inflation prints where goods prices are moving higher. Again, the Fed has said that tariff pressures are likely to be transitory. And so I believe the market's taking those goods prices moving higher as something that might be here for a while, but fade away over the next couple of quarters. Services prices are a little bit of a different story. We wouldn't expect those to be moving higher specifically because of tariffs. And so if we see some stickiness in those services prices, I believe the market would react negatively to that, anticipating that it might impact the way the Fed thinks about interest rate cuts moving later into the year.
All right, let's talk more about the broader markets. Why do you think we saw money go into staples yesterday, generally a defensive trade? What is the basic sentiment right now? I mean, we do have to keep in mind the markets are still very close to all-time highs.
That's right. And I think any skittishness that we saw yesterday specifically might be related to the dynamic that you and Elaine were just discussing with new measures imposed on companies related to tariffs, a little bit of uncertainty about what that might look like, and of course, uncertainty about the data today. Concerns, frankly, about how all-time highs might not be pricing in so very many risks. Now, what I interpret the market to be doing effectively over the last several weeks is saying, look, we're taking a half step back from the news flow, the day in, day out related to trade in particular, because those provisions have been liable to change and haven't been showing up as meaningfully in the data as we expect that they might into Q4. Now, I want to be clear, we're not bearish on the market, but I do anticipate that those dynamics, the changes in policy we've seen over the last few months, to start making a bigger showing in the data here in the coming months. And so we're cautious about how we take equity risk in particular, given the valuations we're at today.
All right. Something I'm surprised we took this too long to get to, the temporary tariff reduction between the U.S. and China being extended all the way through mid-November. What does that mean for the markets? Was that already priced in that this was going to happen? Because we had a lot of guests come on our show, just to be honest, saying they just expected to be extended. What does it mean to have another 90 days for these two sides to talk?
Well, it's certainly good news in the near term, but the way that we're treating tariffs specifically with related to China is, again, we're taking a half step back from the day in and day out, because concern about U.S.-China competition related to economic security, national security, that's a bipartisan trend and something that has begun taking place over the last 10 years, maybe even more. And so this isn't a development that we expect the president or any future administration to step back from altogether. And so I anticipate over the next year or so that the average effective tariff rate on goods coming from China is moving higher, regardless of what the ebb and flow looks like here in the near term. So that might be a way of saying that this is good news in the near term. It takes a major risk off the table for now, but the trend in our view is very clear.
Can I ask you one other thing? We're seeing a lot of corporate buybacks. In fact, we're on pace for over $1 trillion in 2025, perhaps a record pace. Is that an underpinning of the market that you think is being under thought about, and the fact that if that slows down, that might have a negative impact on the direction of the S&P and the NASDAQ, specifically because it's big banks and big tech companies that are doing the buybacks?
Yeah, I think it's an interesting development and certainly contributes to purchasing on the margin. Similarly, we see a different marginal buyer in retail stocks recently. We view this as an important contributor to market momentum. Something that's interesting, we do a Black Swans report every year, trying to think about what are the things that could actually happen in a given year that might disrupt the market. And limits on buybacks is something that we thought that the sort of deregulatory impulse that we've seen from this administration so far might actually be balanced with. And so it's certainly an important development in markets and one that we think could potentially be at risk as we move into the new year.